I have spent decades watching people lose money the same way over and over. They wait for the announcement, they wait for the headline. By the time the news says buy, the smart money already bought, already waited, and is already sitting quiet, letting the position grow, while everyone else argues about it on television. Most people think Warren Buffett makes his money by being right about the future. They are wrong. The real game is being early and being boring, long before anyone calls it a trend. During my years studying how Berkshire Hathaway actually moves money, not how the news describes it moving, I learned that the loudest headlines are almost never where the real decisions get made. Stay with me. By the end of this, you will know 4 specific places Buffett's company has been quietly adding money, and one habit you can copy today, not next year, that has nothing to do with picking stocks at all. Let me tell you about a man named Dennis. Dennis is not his real name, but his story is common enough that you have probably lived a version of it yourself. Dennis watched the news every night. Every time a stock got mentioned as the next big thing, he wrote the name down. In 1 year alone, Dennis made 14 trades chasing stories he heard on television. He made money on 3 of them. He lost money on 9, 2, he broke even. By the end of the year, after fees and taxes, Dennis was down 11%, while the overall stock market was up almost 9% that same year. That is a 20-point gap between what Dennis did and what he could have done by doing nothing at all. 20 points. Think about what that means over 10 years, not one. That gap compounds. It does not forgive itself. It gets bigger every single year. Dennis keeps repeating the pattern. Here is the cost of the belief that news equals opportunity. If Dennis had simply owned an index fund and read nothing, watched nothing, and reacted to nothing, his money would have grown quietly while he lived his life. Instead, he spent hours every week reading headlines and paid for that time with real, measurable losses. The wrong belief is not free. It has a price tag, and the price tag is usually paid in silence, months later, when nobody is looking. The new mental model is simple enough for anyone to use. Ownership decisions get made quietly, long before the public hears about them, and by the time a stock is famous for going up, the early money already made its profit and is looking somewhere else. The single idea that runs through everything I'm about to tell you is this. Watch what gets bought quietly, not what gets announced loudly. This is where Berkshire Hathaway becomes useful to study, not because you should copy every trade, but because the company is legally required to disclose its stock positions every 3 months, whether it wants to or not. That filing is called a 13F. It is public. It is boring. Almost nobody reads it carefully, which is exactly why it is valuable. An investor I once studied treated these filings the way a detective treats fingerprints. He did not care what Buffett said in interviews. He cared what Berkshire actually bought with real money, because money does not lie the way words sometimes do. That investor built a simple habit around this. Every quarter, when the filing came out, he spent 30 minutes comparing what changed. Nothing more. No hot takes, no trading based on rumors, just 30 minutes, 4 times a year, watching where the money moved. Over 11 years, that habit alone helped him avoid 4 separate popular investments that later fell apart, simply because he noticed Berkshire was not buying them either.
There is something else worth knowing before we go further, because it changes how you should read everything I am about to tell you. Berkshire is sitting on one of the largest cash piles in its entire history, well over $300 billion in reserve, money that is not invested in stocks at all. Most commentators treat this as a sign of fear, as if Buffett and his team believe a crash is coming and are hiding from it. I want you to consider a different explanation, one that fits the pattern far better. A company holding that much cash while still, quietly, adding to specific positions in specific sectors is not a company that is afraid of the market. It is a company that is being selective inside a market it considers mostly overpriced. The cash is not a retreat. It is ammunition, saved for the businesses that clear an extremely high bar while everything else gets ignored. That distinction matters, because it tells you these 4 sectors were not chosen out of desperation to put money somewhere. They were chosen out of hundreds of possible options, while trillions of dollars in other opportunities were passed over entirely. I am going to walk you through 4 sectors where Berkshire has been quietly adding money in recent filings, why each one matters, and what it tells you about how a careful, patient mind thinks about risk in a loud, impatient world. The first sector is technology, and I want you to understand why this is unusual before I tell you what happened. For most of his career, Buffett avoided technology stocks almost entirely. He said many times, in plain language, that he did not understand the businesses well enough to bet on them with confidence. That changed years ago when Berkshire built a massive position in one technology company it viewed less as a tech stock and more as a consumer products company with a loyal customer base. Recently, Berkshire's filings showed a large increase in a different technology holding, a company built around search and online advertising, with the stake growing by more than double in a single quarter. Not a small addition, a dramatic one. Why does this matter? Because Buffett does not make dramatic moves on a whim. Every large purchase goes through Berkshire's investment team, and every purchase has to survive brutal questioning before it happens. The first objection people raise is that technology stocks are too expensive and too unpredictable for a value investor to touch. Kill that objection with this fact. The company in question generates enormous, steady cash from advertising, search, and cloud computing, 3 business lines that do not depend on hype to keep working. The second objection is that Buffett is too old-fashioned to understand modern technology companies. Kill that objection by remembering that Berkshire's team includes younger portfolio managers specifically brought in to widen the kinds of businesses the company will consider. The third objection is that by the time a position like this shows up in a filing, it is already too late to matter. Kill that objection by remembering that Berkshire holds positions for years, sometimes decades, not weeks. Being a quarter behind the purchase does not mean you missed the value. It means you are watching a long story in its early chapters instead of its final page. Here is the arithmetic that makes this real. Janet put $10,000 into a technology company the week a celebrity investor mentioned it on a podcast, and held it for 8 months before panic selling during a rough quarter, walking away with about $7,000. Mike put $10,000 into a boring, cash-generating technology business. The same week Berkshire's filing showed a large increase in that position, and simply left it alone for 4 years. Mike's money grew to roughly $17,000 over that period, based on the kind of steady compounding a durable, cash-rich business tends to produce. Janet acted on excitement. Mike acted on evidence. The difference between them was not luck. It was patience attached to a specific signal. So step 1 in your life this week is this. Pick one boring, cash-generating business you already understand, and instead of buying because of a headline, spend 15 minutes checking whether the money behind that business has been quietly growing its position over the last year. The second sector Berkshire has been quietly building is housing, specifically home-building companies. Recent filings showed a meaningful increase in a major home builder, with the position growing by more than 40% in a single reporting period. Most people hear housing and think about mortgage rates, headlines about affordability, and news stories about a slowing market. That is exactly the noise that keeps most people out of a sector while patient money quietly moves in. The first objection is obvious. Interest rates have made housing expensive, so why would anyone add to home builders right now? Kill that objection with the fact that home builders with strong balance sheets can survive slow periods that bankrupt weaker competitors. And when the market eventually turns, the survivors capture demand that used to be split among many more companies. The second objection is that housing is too local and too unpredictable for a big investor to understand nationally. Kill that objection by remembering that large home builders operate across dozens of markets, spreading out the risk of any single city having a bad year. The third objection is that Buffett has never been known as a real estate investor. Kill that objection by remembering that Berkshire already owns real estate brokerages and building products companies, meaning housing has quietly been part of the company's world for years, just not always in the form of home builder stock. Consider the arithmetic again. A woman I once studied, we will call her Renata, sold her home builder stock the moment mortgage rates rose, convinced the sector was finished, and moved her $40,000 into cash, where it earned a small, steady return with almost no risk of loss. A man named Tobias held his homebuilder position through the same rough stretch, because he had noticed Berkshire increasing its own stake during that exact window. 2 years later, as the market stabilized and weaker builders exited the business, Tobias's $40,000 position had grown to roughly $58,000, while Renata's cash had barely kept pace with inflation. Renata protected herself from a loss that never fully arrived, and in protecting herself, she gave up the gain that came right after the scary part. Fear felt safe. It was not free. Notice something else about the housing example, because it applies far beyond stocks. The home builders that survived the slow stretch were not the flashiest ones. They were the ones with the least debt, the most cash on hand, and the discipline to keep building at a steady pace instead of overextending during the good years. That is the same quality patient money looks for in every sector, not just housing. A business that can survive a bad 2 years without panicking is a business that can eventually thrive during the good ones, simply by still being around when weaker competitors are gone. Look for that same quality in your own life. The version of you that keeps a small cushion of savings, keeps spending under control during good months, and does not overextend when things feel easy, is the version of you that survives the hard years other people do not. So step 2 in your life this week is this. Find one sector everyone is currently afraid of, and instead of asking whether the fear is loud, ask whether the fear matches what the largest, most patient investors are actually doing with their own money. The third sector is one almost nobody expected: media. Specifically, a large newspaper company saw its position inside Berkshire's portfolio nearly triple in size in a recent filing. Newspapers. In an era where people say print is dying, a patient, careful investor was quietly adding to a newspaper company's stock. The first objection writes itself. Newspapers are a dying business, so why would anyone increase a bet there? Kill that objection with a simple distinction. The value is not in printed paper. It is in a subscription business built around information people are willing to pay for directly, month after month, without needing advertisers to fund it. The second objection is that this kind of business cannot grow anymore, only shrink. Kill that objection by remembering that digital subscriptions, product bundles, games, and recipes have turned some legacy media companies into recurring revenue machines that look less like a newsroom and more like a subscription service. The third objection is that this is too small a position to matter, a rounding error in a massive portfolio. Kill that objection by remembering that Berkshire rarely buys anything as a rounding error. Every position reflects a decision that passed through serious scrutiny, even the small ones. Here is the arithmetic. A young investor named Priya bought shares in a struggling regional newspaper chain, drawn in by a cheap price, and watched the company shrink for 3 years as advertising revenue kept falling, turning her $3,000 into roughly $1,800. A different investor, an older man named Walt, bought shares in a national media company with a strong digital subscription base. The same quarter Berkshire's filing showed a large increase in that exact holding and held for 3 years while the subscriber base kept climbing. Walt's $3,000 grew to approximately $4,200 over that period. Same industry label, completely different business model underneath it. The lesson is not buy newspapers. The lesson is that an entire industry can look dead from the outside. While specific, well-run businesses inside that industry are quietly becoming more valuable every single year. This mistake, judging an entire category instead of one specific business, is one of the most expensive habits an ordinary investor can carry, because it feels like wisdom while you are doing it. Saying newspapers are dead feels like insight. Saying gas cars are finished felt like insight to a lot of people a few years ago, right before some of the strongest car companies in the world posted record profits selling exactly that. Broad, confident statements about entire industries are almost always wrong at the edges, because every industry contains both the companies that are dying and the specific ones quietly adapting faster than anyone gives them credit for. Patient money does not bet on categories. It bets on specific businesses with specific numbers, and it is willing to look foolish for a while, buying something everyone else has already declared dead, because the actual balance sheet tells a different story than the headline does. So step 3 in your life this week is this. Before writing off an entire industry as finished, ask whether you are judging the industry's reputation or one specific company's actual numbers. The fourth sector worth walking through in full is energy, specifically oil and gas, where Berkshire has continued accumulating shares in a major producer across multiple quarters in a row, not just one. This is not a single bold purchase. It is a slow, repeated pattern of buying, quarter after quarter, the kind of pattern that almost never shows up in a headline because no single quarter looks dramatic on its own. Only when you line up several filings side by side does the pattern become obvious. Most investors treat energy stocks as a short-term trade, something you jump into when prices spike and jump out of the moment prices fall. That behavior turns energy into a casino instead of a business, and it is exactly the trap patient money avoids. The first objection is that oil is a dying industry, being replaced by cleaner energy sources, so why would a serious investor keep adding to it? Kill that objection with a basic fact about time. Even under aggressive projections for cleaner energy, the world is expected to depend on oil and gas for a large share of its total energy needs for decades to come, not years. A slow decline over 30 years still leaves enormous room for a well-run producer to generate cash the entire time. The second objection is that energy prices are too unpredictable for anyone to invest in responsibly. Kill that objection by remembering that the specific company being accumulated here has spent years paying down debt and lowering the cost of pulling oil out of the ground, meaning it can stay profitable even when prices fall, unlike weaker competitors who need high prices just to survive. The third objection is that Berkshire only holds this position because of a personal relationship, not because of the business itself. Kill that objection by remembering that Berkshire has walked away from personal relationships before when the numbers stopped making sense, and the fact that this position has kept growing quarter after quarter tells you the numbers are still making sense today. Consider one more piece of arithmetic before we move on. A trader named Costa bought and sold the same energy stock 11 times over 18 months, chasing every price swing he saw on the news, paying trading fees each time and triggering short-term taxes on every gain. After all that activity, Costa's original $5,000 had grown to about $5,400, a small gain that barely covered the effort he put into watching it every day. A woman named Beatrice bought the same stock once during the same 18 months and simply held it without checking the price more than once a month. Her $5,000 grew to roughly $6,800 over the same period, with far less stress and far less time spent staring at a screen. The stock was identical. The behavior around it was not. Costa was busy. Beatrice was patient. Patient won. Now I want to talk about why almost nobody actually does what I just described, even after hearing it laid out clearly. This is the part most videos about saving and investing skip completely, and it is the part that actually decides whether any of this changes your life. You will not fail because you do not understand the framework. You will fail if you fail at the exact moment your emotions overpower your plan. Picture the moment. The market drops 8% in a week. Your phone buzzes with a red number every time you check it. A friend tells you they sold everything and moved to cash, and for a moment that sounds like the smartest thing anyone has ever said. Your hands are literally shaking as you open the app to sell. That is not weakness. That is biology. Your brain is wired to treat a foul. Ling account balance the same way it treats a physical threat, and it wants you to run. The fix is not more willpower. Willpower runs out exactly when you need it most, usually late at night, alone, scrolling through bad news. The fix is structure that removes the decision from the emotional moment entirely. Set up automatic contributions that happen whether you feel confident or terrified. Write down in advance, while you are calm, the exact conditions under which you would actually sell something, and refuse to sell outside of those conditions no matter how loud the fear gets. Remove the investing app from your phone's home screen so that checking it takes an extra 10 seconds of friction, just enough to break the reflex. A retired teacher I once studied, we will call her Alma, did exactly this before a rough year in the market. She had already decided months earlier that she would not touch her account unless she needed the money for an actual bill. When the bad year came, she felt the fear just like everyone else. But she had already made the decision while calm, so the panicked version of herself had nothing left to decide. Her account recovered fully within 18 months. Most people who sold during that same period never got back in at the right time, and many of them are still waiting, still watching, still afraid to try again. This is where most videos about money lose their audience, because this part is not exciting. There is no clever trick here, no secret number, no hidden formula. The fix is boring on purpose. Automate the decision before the fear arrives, because you cannot outthink panic once it has already taken hold of you. There is a second version of this same trap, quieter than panic selling, and in some ways more dangerous because it does not feel like a mistake while it is happening. It is the slow drift toward doing nothing at all. A man I once studied, we will call him Franklin, never sold in a panic. He simply never started. Every year he told himself he would begin once things settled down, once he understood the market better, once he had a little more saved up as a cushion first. 10 years passed this way. Franklin did not lose money the way Dennis did. He lost something quieter and harder to measure, 10 years of compounding that can never be recovered no matter how much he saves later. Waiting feels safe. It is not free either. It has a cost, and the cost is time, which is the one resource nobody gets back once it is spent. The structural fix for Franklin's version of the trap is the same as the fix for panic. Remove the decision from the moment. Set up the automatic contribution once, on a day when you feel calm and clear-headed, and let it run in the background of your life without needing your daily approval. Do not wait for the perfect entry point, because patient money, the kind we have been studying this entire video, does not wait for perfect either. It buys steadily, in good quarters and bad ones, and lets the average work itself out over years instead of trying to time a single perfect moment that mostly exists in hindsight. Let me bring this back to where we started. Dennis chased headlines and paid for it in silence. Renata sold out of fear and missed the recovery that came right after. The pattern underneath every mistake in this video was the same pattern: reacting loudly to something instead of quietly studying what patient, serious money was actually doing. Buffett's real advantage was never a secret formula only he understood. It was the discipline to move slowly, watch carefully, and let time do the heavy lifting instead of trying to force an outcome through speed or emotion. Here is the one sentence that holds this entire video together. Quiet, patient decisions made away from the noise almost always beat loud, urgent decisions made inside the noise. This is not just true about money. It is true about how you build a career, how you raise a family, how you take care of your own body, and how you spend the only years you are ever going to get. The people who build something lasting are rarely the loudest people in the room. They are the ones who decided early, stayed calm through the scary parts, and kept adding to their position in every sense of that word long after everyone else had stopped paying attention. This is not really about becoming rich in the way people usually picture it, with mansions and headlines of your own. It is about buying yourself options. It is about reaching a point in your life where a bad month does not control your mood, where a scary headline does not decide your next move, where you have built enough quiet, patient structure underneath your life that the noise simply stops reaching you. That is not wealth in the flashy sense. That is peace. And peace, once you have it, is worth more than any single stock pick I could ever hand you. Think about what decades of this kind of patience actually buy a person, beyond a number sitting in an account. It buys the ability to take a lower-paying job because you love the work, without fear ruling the decision. It buys the ability to help a family member through a hard year without wondering whether you can afford to be generous. It buys quiet mornings instead of anxious ones, because the version of you from years ago already made the hard decisions while calm, and the version of you today gets to live inside the results of that discipline. None of that shows up in a headline either. The most important financial decisions of your life will almost certainly happen in silence, in ordinary weeks, with no cameras and no applause, which is exactly why so few people ever make them on purpose. I am not asking you to trust me. I am asking you to trust the pattern. Watch what patient money does, not what loud money says. Build one small piece of structure this week, whether that is an automatic contribution, a written rule for when you will actually sell something, or 30 quiet minutes once a quarter to check what has changed. Small, boring, repeated actions, done consistently over years, will outperform almost every clever idea you will ever hear shouted at you from a screen.